I'm going around taking them down, and this guy called me up. He goes, "Hey, I got this mobile home for sale. It's worth 21,000. Give me 18,000." I go, "I'm not interested in a mobile home." A week later, he goes, "Give me $15,000. I told you I'm not interested in a mobile home." Another week, goes, "Give me $12,000. I'm not interested. Sorry." So then a month goes by. He calls me back again. He goes, "Give me $6,000. It's worth 21,000." Now in the back of my head, now I knew it's a deal. So I said, "I told you I'm not interested in a mobile home, but this is what I'll do to help you out. I'll give you 3,000." So then what I did was place an ad in the newspaper immediately, like mobile home for sale, $25,000, owner financing with $3,000 down. Lady called me up. So they gave me the $3,000. I took that $3,000 and gave it to the seller to buy the property. And I created a note for 7 years at $300 a month, around like 8%. And that was my first creative real estate deal.
Hey everybody, welcome back to Break Free from Wall Street, the show where we teach investors how to build wealth outside the stock market. I'm your host, Nick Sahagun. Today's guest has done over over $500 million in real estate transactions over the last 30 years, without relying on banks, from what I understand, for most of it. I'm of course talking about Mark Monroe. Really glad to have you here today. Mark, you're the best-selling author of Creative Real Estate Investing, a real estate developer, host of the Real Estate Power Play podcast, where you help investors put their capital to work in real estate. Welcome to the show. Super excited to have you on today to share your expertise.
Nick, I appreciate it. Thanks so much for having me on. And thank you so much for taking care of me and a lot of the people that I've been referring over. Everybody talks really highly of you guys. So thank you so much for having me on. I appreciate it.
Absolutely. It's our pleasure. Really, really excited for today's episode. We're going to go deep on seller financing, really the strategy that you've built your career on. And I think if my numbers are right, around 80% of our investors with Safeguard Advisors doing self-directed IRAs are investing in real estate in some shape or form. So I think this is really going to be valuable for, the bulk of our listeners, and even people who may not be investing with us, who are just looking to learn about, the options and strategies that they can use to invest in real estate, either with retirement capital or personal capital. So really excited to dig into it today. I really want to I want to dive into your background a little bit first, so we can get an idea of who you are, where you came from, what your experience stems from. Uh, you started off, I mean, you grew up with not a lot of access to money, poverty, I think is what we would call it. And then, like I said in the intro, you've gotten to a point where you've done over $500 million in real estate transactions. Take us through what led to that. What led to that transition? What was the deal that flipped that switch when you realized that this was actually something that could work for you?
Sure. So yeah, thank again, Nick, so much for having me on. So I grew up in a small town in Vermont, and I think the population, I think it was like 7,000 people. And around like the age of 6 or 7, somewhere in that area, my dad left. So it was my mom raising us and myself and two sisters. And my mother, she didn't have any, she was trying to take care of us. And I remember like for 3 months straight, all we ate was fat macaroni and cheese out of a box. I remember it was 29 cents because I was the one I was
Mm,
walking to the store getting it at that age. And then during that same time period, I remember, because Vermont's cold and my mother didn't have money for fuel. And I think that was fuel. And then we had an electric stove, so we all had to sleep on the kitchen floor. So, and then I had to do some odd jobs, mow lawns, babysit, shovel, whatever it was to help put food on the table. So then when I was 14, 15, I went to work at McDonald's. I lied in the application, said I was 16. Back then it was easy. So I went to work at McDonald's. I remember starting out at like $3.05 an hour. That's how crazy it was back then. And
wow.
and so on top of it, I have ADHD. And back then they didn't know what it was. So I was always that problem child sitting in the school in the front of the desk in elementary school. But in the fast food world, I excelled because I could multitask and could do a bunch of things at once. And I excelled in corporation of the McDonald's pretty quickly. I remember I was a senior in high school running a store, and I just threw myself right into it. And then learned business. I learned how to handle people. They paid for my schooling. And then from there, I was transferring down to the Baltimore, Washington, D.C. area. But I did my first deal at 19. I had no clue what I was
Wow.
doing, but then I still got stuck in the corporate world, and I didn't really get full time into real estate till about 24, 25. I started out, I saw this article like, to learn more about loan originating because I wanted to get in real estate. So I became a mortgage broker. I took this course. This guy said, "Hey, why don't you come to work for me?" Actually, I was a loan officer with this group, and then I was there for about a month and a half. Met my two partners. We left. We became a mortgage broker for about a year. Then we end up getting our own a warehouse line with Mellon Bank, and we end up having 109 mortgage loan officers, team of underwriters. So I started surrounding myself with like-minded individuals, and then I just knew the banking side of sorry, I knew the banking side of things, and wanted to start buying property, like how to buy property with no money down. And that's kind of what I fell into. And I started doing what was we call sandwich lease options, where I'd go under a contract. I'd call a seller up, say, "Hey, would you be willing to rent the property to us for a few years? We'll close on it. We'll take care of the maintenance and repairs," and allowed me to sublet it. And a lot of times, oh, I need my capital out of my property. So I'll refinance at home, pull the capital out. And then, oh, by the way, your new home, I want to do that loan. So, I was around like 26, 27. And off of one lead, I was making like $35,000 because I was
Wow.
refinancing a loan, then doing the next one, and then what we call is an option fee. And I just started doing these deals with no money down. And that's really how it started. But believe it or not, my first deal creatively, and I should have was 19 and I had no money. And it was a mobile home. And this guy, I went around, I did this Carlton Sheets. I don't know if you might, I don't know if you ever knew who Carlton Sheets was. He was kind of like a big godfather of, real estate investing during the infomercials back in the day.
Hmm.
Anyways, what happened there? He had a question or something. I was going to tell you that story real quick, but go ahead, Nick.
No, go ahead. Yeah. Sorry, I had a light go out and it kind of
It's
distracted
all
me.
good. So what happened when I was 19, I did a Carlton Sheets and I took a cardboard box, cut it out, and took a wet magic marker inside and put "We Buy Houses." I went around the town putting them on the telephone poles and probably, I don't know how many I put up, maybe 18, 15, I don't remember. So I got in trouble by the municipality. I didn't know. Like they called me up. I'm like, "I'm sorry. I didn't know I couldn't put signs." I was 19 years old. So I'm going around taking them down and this guy called me up. He goes, "Hey, I got this mobile home for sale. It's worth 21,000. Give me 18,000." I go, "I'm not interested in a mobile home." Calls me back a week later. He goes, "Give me $15,000. It's worth 21,000." I go, "I told you I'm not interested in a mobile home." Calls me back another week. Goes, "Give me $12,000. It's worth 21." I go, "Well, do you own the land?" He goes, "No, it's in a mobile home park." I said, "I'm not interested. Sorry." So then a month goes by. He calls me back again. He goes, "Give me $6,000. It's worth 21,000." Now in the back of my head, now I knew it's a deal. So I said, "Why did he kind of sell?" He goes, "Oh, I got lot rent due and I just really don't have the money and blah, blah, blah." I said, "I told you I'm not interested in mobile home, but this is what I'll do to help you out. I'll give you 3,000." He goes, "Oh, give me 4,000." I said, "I'm not interested." He goes, "All right, I'll take the 3,000." So then what I did was, I said, "All right, I have to go to the office supply store to get a contract because we didn't have the internet to get contracts back then." Oh, he goes, and I said, "I'll go ahead and go get a contract and meet you out there." So I hung up the phone, placed an ad in the newspaper immediately, like owner finance. I'm sorry, mobile home for sale, $25,000, owner financing with $3,000 down. Lady called me up. Her husband went out there. They liked it, so they said, "All right." So they gave me the $3,000. I took that $3,000 and gave it to the seller to buy the property, and I created a note for 7 years at $300 a month, around like 8%. So at 19, that was my car payment and my insurance payment for seven
Mm.
years. And today, that's probably about $800 in today. So that was my car payment, insurance payment. That was my first creative real estate deal. And anyways, that's how I got into the game and just started networking. And I've been just doing everything, every type of deal you can think of, pretty much.
That's incredible. And I think a lot of our audience who has that experience in real estate can kind of attest to that first deal where you really are just figuring out, but it really starts to, set you on the path and really opens those doors that will lead to, your future success. But I think that's really the hardest deal to do. Do you find that to be true that the first deal was the hardest because you didn't know what
Yeah,
you were doing or
because I was like, I wanted to buy real estate and I had no money. My credit, I just started out, or well, really what happened is, can't believe I'm telling you this. So also around that age, 18, 19, I'm like, because no, my mother was financially literate. No, I didn't learn how to balance a checkbook. I didn't know anything about finance at all. I started learning it through McDonald's.
Yeah.
But before then, I'm getting these credit cards. I'm like, oh, this is cool. I'm getting these credit cards. I was the guy going out buying I'm like, all right, I'll go buy this keg. We're doing keg party. I'll go buy it. No problem. Next thing you
Yeah.
know, I had 28 credit cards all maxed out. I'm like, what?
My
Those
God.
they're small. They were like,
Right.
200, $500,
Yeah. Yeah.
but you didn't know any better. And I'm like, so I maxed these credit cards out and I'm like, going buying clothes and I thought I was the man and buying trying to be a show off to all these girls, at that age, 18, 19, that type of thing. And
Yeah.
so I got myself even in a little bit of hot water for a couple of years. So my credit started taking a hit too at that time,
Mm,
because I didn't learn a lot of that stuff. So it took me about 3 years to kind of clean that mess up. Because, oh, what's this? 18, 19, back then it was actually in the late 80s, early 90s. I want to say it was upwards in like high 20% interest rates on credit cards back then.
wow.
Yeah.
Yeah.
So, like you said a second ago, it seems like it's always hard doing that first deal and how to get it done. And you don't have the capital and you always like feel like your head between your legs and going like, hey, do you mind giving me some money so I can buy property? That type of thing to
Hmm.
your friends and family. But the, and plus you're kind of new at it, so you're scared to ask. But in today's world, like, hey, I have these deals, I know what I'm doing, I can give you an opportunity so you can make much more money on your return on your capital, especially people with IRAs and Ks, mainly, the checkbook, any type of IRA that we put the capital to work and our different type of projects in today's world.
Yeah, absolutely. And like I said before, like 80%, I think maybe even higher of our clients and a lot of self-directed investors, I think it's probably around that same percentage. If you have a self-directed IRA, chances are you are investing in real estate. And so from your perspective, um, if what would you say it is about real estate that Wall Street pitch, those conventional assets can't compete with?
I would say one of the biggest things is if you take $100,000 that you have in
Hmm.
your IRA, your 401k, or even 50,000, whatever you want to call it, say the $100,000. If you take that $100,000, especially in the seller financing world or other spaces, you can leverage up to $2, $3 million control of real estate with $100,000. But if you go into the stock market, you put $100,000 into the market, you're still at $100,000. So
Right.
because you can borrow against it and use the real estate asset as leverage because that's that collateral. And I think that's the biggest thing. Like I could take $100,000 and control a couple $1 million of real estate asset, where if you take the $100,000 in the market, it's $100,000. Yeah, it may go up a little bit, maybe 105, 105,000, maybe 110. That's probably the biggest eye opening. Now, granted, sometimes, in the past, well, lately, because before real estate was always a better investment, but in the last several years, the stock market's been a little bit outperforming the real estate market, the returns lately because of that. But we want to diversify, especially people that have been in the market for quite some time. We witnessed what happened in 2008. We've seen markets
Mm,
collapse. We've seen it where you want to diversify. Most people that understand the second thing is 90% of millionaires in our country, it comes through real estate. 90% roughly make it through real estate that become multimillionaires.
yeah, it's definitely over proven itself to be one of the most, if not the most, wealth generating strategy out there. And I want to get more into where you really excel and where you can really provide your expertise with seller financing. For someone who's just barely getting into real estate, maybe hasn't even heard the term seller financing, how would you explain that? Like if you were like explaining it to like a neighbor over the fence, and why does this even exist as like a legal option?
Sure. Well, there's many different type of seller financing. A lot of times when people talk seller financing, they go thinking that the seller, um, where the seller becomes the bank, sellers carrying the mortgage where the property's free and clear. 40% of mortgages out there don't. 40% of properties have no mortgage on the property, especially the baby boomers coming into play even more. 40% have no mortgage. But then there's strategies also if there is a mortgage on the property. They're called a little different, but we still wrap it together in the seller financing because you're creating a structure with the seller and yourself if you're the buyer. You don't have to jump through hoops. You don't have to. Some sellers will make you qualify, but you don't have to qualify. You don't have to show all the income documents. You don't have to do all that stuff. Now, me as an investor, I do let to qualify my people because there is some consumer protection regulations that we need to make sure that that buyer can afford the property. We're not just taking a large down payment and running. But typically, the mom and pop people are not aware of it, and they're just doing a typical straight seller financing. And it's great also, like somebody, like this market condition, if the home is not moving, you can turn it and it's sitting vacant. There's another opportunity, another way to do seller financing to sell the property. And it
Mm.
plus it works on the buyer side because if you can't qualify, say you have some credit challenges. Let's say that you're self-employed and you can't show income. A lot of times they can't show that. So that's another good reason why we do seller financing that way. And one of the things I had that large Facebook group called Seller Financing Homes where roughly get about 3 million eyeballs through there a month on that. And one of the things that when they join the community is like, hey, how many people are looking for a seller financing home as a primary residence? And when we help them through that process because they don't even know they're coming there because they want to become a homeowner, just like what we talked about buying real estate. A lot of people think it's really hard, but it's if you just need the education of learning how to do it because everybody's going through your traditional, the vanilla realtor that only knows the
Hmm.
traditional transaction, going through a loan officer at your local bank or one of the online mortgage companies. And they have guidelines and programs that they have to follow because most of those guys are selling that mortgage off into the secondary market and having Wall Street buy it. So this is another way alternative. And that's where I was just this weekend, I was in Nashville speaking at the Seller Financing Note Conference because besides doing what we talked about earlier, Mike referred somebody over to you where he buys and sell notes. So
Hmm.
you can learn how to structure deals through seller financing, originate seller financing, and sell that because you can sell it as a premium as an investor. Because I always tell them if I have to wait for my capital for 5, 10 years, I'm going to sell this property at a premium. So whatever the as is value is, let's say it's 300,000, I'm going to sell it probably for 330, 10% more because I have to wait for my capital. Okay. There's one
Mm.
aspect of it, but you still want to make sure they can afford the property. That's one of the things you always want to make sure. I look at what the market rent is in that area. And I want to back my numbers in to make sure that makes sense. Then you can take that. I can get that passive income coming in because if you ever, whoever, I would recommend playing around with the amortization schedule. As an amortization schedule show you how much interest because usually the first 10 years every time you make a mortgage payment, majority of that is going towards interest. That principal mortgage balance is not coming down very fast, which you probably see on your stuff when the people that you see coming through. But anyways, I could go on and on and on about this.
Absolutely. I mean, you've got, like I said, 30 years of experience, not just in real estate, but in these creative financing strategies. So I guess to boil it down to the why would a seller agree to finance the buyer instead of just taking the bank's check at closing? We talked about the flexibility, the ability, the ability to get around some of the regulations of qualifying for that loan. When it boils down to it, what's the biggest thing or things that are actually in it for the seller?
I'll give you an example. Not too long ago, I was talking to this couple in North Carolina, and they had a property that was sitting on the market and they were trying to sell it. And they were open to, it was sitting on the market, said, okay, I'll do seller financing, but I want a 3-year balloon. You know what a lot of people don't know what a balloon is. Do you know what a balloon
No,
is,
let's
Nick?
go over that.
Sure.
Let's go
All right.
over
So a
that.
balloon means you amortize your loan. Actually, I just sent a text message to a gentleman today. He's got a balloon coming up. It's been about 7 years that I've been holding the note on that one. So what it means is you have it amortized. Typically, it's amortized at 30 years, but a balloon means that like this couple wanted a 3 years. So that means in 3 years, I have to pay that loan off. If not, they could take that
Mm,
property back from me. Okay.
right.
So, and I didn't feel comfortable with the market doing a 3-year balloon because I was paying top dollar for that property. I'm willing to pay pretty high, close, if long as they're willing to give me terms, the seller. So, long as they're willing to sell me, so I'm willing to pay a little bit more, as long as they get terms. I don't have to jump through hoops and go to bank and get very low down payments. I can't tell you how many properties I purchased with very little to no money down. I have somebody, we'll talk about that in a second, but 13 units, 0 down. I could go on and on. But anyways, so
Mm,
what I did is I put together an amortization schedule. I have a calculator on my phone. It's an app. It's like $5 to buy at one-time fee, and it produces this beautiful PDF document. And I emailed it over to him. So I jumped on the phone. I said, do me a favor, pull up that document, the amortization schedule. It shows the purchase price, the amount financed, and the down payment, and it showed the monthly payment, and it showed the interest rate on the first screen. So then I said, go down to line 120. Okay. That's 10 years. Okay. I said, in this example, on 10 years, how much money would you have collected for payments? I think they said it was like $89,000. I said, over to the right, because it's a 10-year balloon, what's the balance I got to pay off? And they said it was like 100 and whatever it was. It might have been a little bit more than I don't remember. I said,
Right.
so if you add those two numbers together, how much they're making an extra $172,000 becoming the bank over 10 years.
Wow.
And it's secure against the asset. So, they're worried about, hey, what happens if I default? I said, to be frank, after 5 or 7 years, you want me to default so you can take that property back. But I would never allow that to happen because I've been paying it down. The property's gone up in value.
Wow. So even I guess even the worst case scenario where, like you said, the payment defaults, you still have the asset itself.
I'm sorry, if the payment defaults, what now?
You still have the asset itself. Is
Correct.
that right?
Yeah. Yeah. And I've had those. I'm really good at underwriting my buyers. But I've had situations like that. People get injured, divorce. I've had that happen. I have one right now where a gentleman, this was up in New England, I sold it on a seller financing about 5 years ago. He passed away. And the wife, they got a divorce and she didn't want anything to do with the property. And I'm the one that has to take it through probate. But I'll get
Mm.
and I had to put a little bit of money to fix it. But when it's all said and done, I'm going to come out ahead. So typically you do come out ahead when you sell it in seller financing, or you can do, a lot of times I try to do with cash for keys. So I don't have to go through a legal process. And that's the other thing, what I've learned over the years is when I do these type of deals, seller financing, buying it, selling, tenants, or whatever, when I have that first conversation with them, and this is where most investors go wrong, is it's more about relationship. So when you talk to somebody, this is the best way. It's a marriage. You're in a contract with the seller or the buyer, whatever it may be. So when I had those conversations, the first time I'm talking to them, I'm getting to know them. Think of the first time you went on that date with a significant other. You're getting to know each other. So 80% is getting to know them, and I want them to get to know me. And I had a deal not too long ago where somebody was open to seller financing, and he originally wanted $30,000 down, but the house was only worth 128,000. This is one of my students who are my members, and I got on the phone with them, and I already knew what the problem was. So I built a rapport with him. I jumped on the phone. I found out the most important thing at that moment was his dog. I found out he had grandchildren. I found out he's got a huge Atlanta Falcons fan. Found out that out. I found out that he banks with a credit union. He's got good credit. He's retired and he lost his wife. So I'm on the phone building this rapport with him for probably a good half hour. His name is Robert. So, hey, Robert, what are you planning on doing with that $30,000? He goes, oh, I need $25,000 for a camper and I want some spending money. I go, camper? Where are you going to go camping? Like that. He goes, I'm going to go on the New River in West Virginia, then into the Shenandoah
Hmm.
Mountains up in Virginia, and then into Tennessee and Ohio. Let me ask you a question, Nick. When's the last time you've been camping?
Geez, it's probably been at least 5 years, maybe 7. Been a
Anybody
while.
listening right now, think of the last time you've been camping? And where did you go? Where did you go camping there?
I mean, just some random place in southern Utah called the Yankee Meadows. Probably not a lot of people have heard about it, but just like a small campground. Yeah.
Was it on the water or was it like a campsite?
There's a small lake reservoir. I don't know what you would call it. Um, but yeah, they have some campsites that you can actually go stay on, but then you can also just find your own, beaten trail and just stay somewhere close to the water.
That's cool. And did you spend the night there?
Yeah. Um, this was actually even probably before I was married, so like 10 plus years ago, now that I think
Wow.
about it. So yeah, I spent the night.
Nice. What'd you guys do?
I
Hiking?
mean, yeah, well, you typically go fishing over at Yankee Meadows. You can do some hiking, but yeah, I was with my college buddies, so it was a lot of
Yeah,
talking and drinking
partying.
and just yeah, just doing stupid stuff. But
So
yeah,
when you woke up in the morning, do you drink coffee?
no, I'm not a big coffee guy. At the time, it was probably Red Bull
There you
to
go.
get me going.
Yeah. But isn't like when you wake up in the morning, you walk outside that camp and it's beautiful and you just take the fresh air and all that right in.
Hmm.
So as I'm asking you this, right, taking you on this journey, were you thinking yourself back at that location again?
Oh yeah, yeah, I can still picture it.
Okay. I did that. I do that same exact exercise with the seller. He's visualizing what his house, what he's going to be doing, what it's like once he sells that property,
Mm.
and who he's with, what family. So he's visualizing, you can feel it. So I did that to the seller. Okay. So then after I did that, I go back to him. I go, so Robert, I noticed you've been trying to sell this for a couple months on seller financing. I go, what seems to be the problem? Goes, everybody's beating me up in a down payment. You know, they want a lower down payment or they're trying to beat me up in a price. I go, how many offers you had? He goes, I had about 12 to 15 offers, all from other investors. So I go, Robert, I'm going to be frank with you. Nobody's going to put $30,000 down on a $120,000 home, but they can go get an investor loan and put less capital down and find a property a little bit more desirable. But this is what I'll do. I'll give you $3,500 down. You mentioned that you bank with the credit union and they got great rates. Go ahead and take the loan out for the camper, the 25,000. And what I'll do is on the 20th of every month, we'll automatically have the payment pulled directly out of our account and we'll make the payment on your behalf. And what we'll do is in a portal, the credit union portal, we'll create an email in there. So every time there's a notice that goes out, it goes to you and it goes to my bookkeeper. We got that deal for $3,500 down and cash flowing $475 a month after making that payment on the camper. So it's because I listened to him, I understood him, and he trusts me, and we built that rapport and a relationship where all these other investors are just throwing numbers out and didn't know why he's
Mm.
selling and what was his issue and how to solve his problem.
So it's more about the person. It's more about the relationship and the because at the end of the day, it's really the emotion behind why you're investing, and like you said, it's kind of like that story of why you're doing what you're doing that really gives it its meaning, and I think gives you the most motivation at the end of the day. So that's really, I love that. One thing I want to touch on specifically is subject to, and maybe I'm not saying that properly, but subject to, I think it's one of your signature strategies, and probably the one, from what I understand, it has the potential to make investors the most nervous. In plain English, can you just tell us what subject to, what that strategy is, and when does it make sense to use that strategy?
So this goes back to again many type of seller financing strategies. I was talking about the lease option earlier. You have also what's called an agreement for deed land contract, and you have subject to. So subject to is the big buzzword because there's a big influencer out there pitched it, hit it just at the right time during COVID. Literally, he launched his program. But the problem with it is he's such a great influencer, but he didn't know enough about the subject to strategy. And subject to what it is you're buying a property subject to the existing mortgage. Like say, Nick, let's say you have a property, you own a home, and let's say your home, you have a mortgage on it, 300,000, right? You went to the bank, you qualified to get that loan, you and your wife, it's in your and wife's name. I come along and say, hey, Nick, and you need to sell your property and you can't sell it. And
Right.
so I will buy that property from you, give you maybe 20, 30,000, whatever, maybe even a second mortgage. You can do stuff like that as well. Like
Okay.
say you have an equity of 100,000, so I'll pay you. But what you're doing is you're transferring the property out of your name over to my name or my LLC, but the mortgage is staying in your name. Okay. So if I stop making payments, it's going to affect your credit, not my credit.
Mm. Interesting.
So now the issue is, and why it makes nervous is, and I've done this has been around for 30 or 40 years, and a lot of the banks and lenders know about it, but it was always designed for investors that are going to buy the deal, stay in the deal, rent it, or what we call as a wrap. And I'll explain that in a second. Well, I'll just explain it now. A wrap means I buy it from you for 300,000 and I turn around and wrap it to another buyer for like 350, 370 and create the arbitrage and say your rate, your underlying rate is like at 3.5, 4%. And then today's rate is at 6.5. So I'm creating that arbitrage. So, but I made my agreement with you. So if my buyer stops or my tenant buyer stops making payments, I step up and I'm supposed to be I make the payments to your mortgage company like Bank of America. The
Right.
problem is with this particular influencer that created this mess. Do you know what wholesaling is?
No, let's go over that.
Okay. Wholesaling was originally designed for fix and flips when the market was hot. It's always been around. So wholesaling means I go out there, I know a fix and flip buyer that's going to buy this property, and he's willing to buy. So this, say this property is um, after repair, we call it after repair value. Let's say it's worth 150,000. I may go out there and I find a deal and I figure out the repairs. I may go to the seller and say, "Hey, Mr. Seller, I'll give you 50,000 for this," right? But then I go out there and find my fix and flip buyer, and he's willing to pay 60,000. So I can take my contract and sell my contract to the fix and flip buyer for $10,000. That's what's wholesaling is. I get it under a wholesale price and I turn on sell it. Always been around, been perfectly fine, but it's not designed to do subject twos. Because a
Mm,
subject to is what they're doing is they're selling that I'm going to you, Nick. Hey, Nick, I'm going to take care of this mortgage. I'm blah, blah, blah. Next thing you know, I sell my contract to somebody else for $10,000. I'm out of it. Right. But
right.
I told you I was going to buy this, and that's the problem. And then those guys are mainly younger people are not qualifying the buyer to make sure they can afford it. They're just looking, all right, I'm getting that $10,000, $20,000 assignment fee selling that contract. But in fact, when you're selling that property, you need to make sure that end buyer can qualify because there's consumer protection regulations. So what's been happening over the 30, 40 years, the default rate on subject to was always below FHA and VA. And right now that's like at 3.2%. I think actually 3.4 just jumped a little bit, 3.4 default rate on subject to, because us investors in the past have always made those payments. And I've had to do that before. I had somebody default, but I made the payments. But I get a large enough down payment to put in reserves to make sure I have enough there.
Right.
But right now the default rate is at 19% because this gentleman blew up and was teaching people incorrectly. And now you see people all over social media teaching this, but they're teaching it incorrectly. It was never designed for wholesale. It was always designed for an investor to buy the property. It's an amazing strategy. I love it. You can buy properties with very little money down that way. I've done a lot of them that way. And you can do really well. You can cash flow. You can build a portfolio up that way, and it can work really, really well. But you should be the investor. So typically, people that I work with have already done like 3 to 6 husband and wives, and they've already bought it traditionally, but they've used all their money of the down payment and they maxed out. So then they go into doing this strategy because when you do seller financing, it's all negotiable with the seller of your down payment in terms. Everything's all negotiable.
Right.
And then the other aspect of it that's dangerous is what's called a due on sales clause. So on a subject to what that means is that when you went to the bank and you took a loan out that with you and Bank of America, you did a contract, you did a mortgage with Bank of America. But once you transfer that over to me, you breached your contract. It's not illegal, you breached a contract. They could call that loan due because you
At
transferred it.
any time,
Correct.
once you, at the
That's the
moment
part
that
that makes
you,
people nervous. So what I
how
do
often
is
does
just
that happen?
it doesn't happen that often. It's usually when people screw something up. What I normally do is I'll go ahead and put it into a trust because people put properties into a trust all the time for probate purposes. So the lender doesn't really know. It doesn't stop it. It just kind of camouflages it a little bit. But typically when it happens is when they're not getting the mortgage payment. That's usually, or they screw something up on insurance. Usually the smaller credit unions and the smaller banks will call it. The big people usually don't call it. They know it's happening. They're in business. They just want their payment. And if
Right.
they go and start calling all these loans due and starting to foreclose on, and these are publicly traded companies, their shareholders are going to have a problem with it. So that's why they leave it in place on the big companies. But typically the smaller ones may have the smaller banks and smaller credit unions. That's typically where you see that happening. But if they do it, you can easily put the deed back in the seller's name and then just do another strategy where I do what's called an agreement for deed or land contract. The deed stays in the seller's name. Some states, I get the deed signed, let it sit in escrow. And then at the end of the term, you can just have that transferred over, or you can do a lease option, just cloud the title, put a memorandum that you have notice of interest in the property. It's pretty straightforward. But I've done thousands of these type of transactions over the years with very little money down. Typically, what I do is I like to negotiate a really low down payment with a seller, help the seller. Like that example I gave you, the camper, I got into a deal
Hmm.
for $3,500. We went out and found a tenant buyer, a rent to own buyer, and he put $18,000 down. So to the $18,000, we end up giving the seller 3,500. We have some closing costs. And I always tell people to put 3 to 6 months reserves in the account. So if anything happens, that tenant buyer stops paying, you have the money in reserves. And I always have my payments. So if the payments are due on the first, my system I had is set up where automatically payments go out on the 25th of every month. So they're automatically sent to the mortgage company, whoever I have to pay. It's the easiest way, even though I may not receive my rent or my mortgage payment from my buyer yet.
Right. That's super interesting. You
It's
also
a lot.
teach it is a lot because you also teach lease options, contracts for deeds, novations, sandwich leases, and a new investor hearing all of these strategies is going to feel overwhelmed. I feel like
It
there's no
is.
two ways around it.
So each of these strategies, I spent about 2 years on each one of these strategies to learn. But now the way I do it, I just listen to the seller and I think of a tool belt. Depending what the seller's needs are,
Mm,
that will determine on what strategy I use. Like, give me an example. Like, if a seller's not financial distress, like if you're selling your home, if you're not financially distressed, there's no way I'm going to pitch a subject to. You're going to look at me like I'm crazy, right? What? Keep the mortgage and name, transfer it over, and then people listening to this may, who would do something like that? Usually it's somebody that's, behind in the mortgage, you're bringing the mortgage current, the house needs work. If I have to put a lot of money into the property, I'm going to want that deed. But again, you can do one of these other strategies to still control it and get into it. So that will determine on really what strategy to do. And the other thing, once you learn how to do these strategies, I'll give you this is another example. I've helped brothers, I helped some brothers buy a plumbing business through a seller financing strategy. Because once you understand the
mm,
seller financing strategy, you can do it for a lot of different things.
right.
Bought this. What they did is they got this deal. It was, I can't remember if it was St. Louis, Kansas City. I don't remember what it was, but it was a husband and wife. They had it for 30 years, and they were open to seller financing. Okay, but the sellers wanted $1.5 million down. Well, they had a lot of assets, trucks and stuff on the road, and they're going to pay seller. And this business was cash flowing really well. Well, what they did is they went out and took a loan out against the business's assets and gave the seller 1.5. So they're paying that business loan assets and they're paying that one. They got in that deal with no money down because they figured out how to use some creative ways of going about it. I'll give me another example. This girl, I shouldn't say girl, she's a lady, Mary Lou. She's out of Hawaii. She was one of my students 3 years ago, and she learned how to do seller financing, different type of strategies. But then she got into the adult living facility. She spent 2 years learning that. She teamed up with a partner that's been in the business for 25 years. They went out and bought their first adult living facility. First, she did some residential stuff, but then they went out and bought the first adult living facility. It was like 80 something beds. Then they did a
Wow.
second one. Her last one that she just closed on about a month and a half ago. It was a creative seller financing deal, and they bought it. I think it was 120 beds. I don't remember. I think it was Detroit or Kansas City, and they paid $5.4 million. They locked this up for 5.4 million. The appraisal came out at 7.5 million,
Wow.
right? And
Right.
to get into that deal, they needed $1.1 million for the down payment and closing costs. And then they needed some working capital. Well, they got the seller kicked back in 1.9 million to be a partner in the new LLC. So she got in that deal with no money down. They have $500,000 of reserves to working capital, and that deal has equity, almost $2 million of equity, over $2 million.
Wow.
That was a home run deal.
That's crazy.
Yep.
And
And
so
another one.
when,
Okay, one more. I'll give you another one because
yeah,
this is
I
really
want to,
what I'm. Yep. This was another one. So it was about 7 years ago. It was outside another one in North Carolina, outside of Charlotte. This guy wanted 1.5 million for this piece of land. It was free and clear. I don't remember how many acres, but it was on public water and sewer. So what I did is the seller instead of 1.5 million, he ended up making 3.1 million. What I did was I brought a builder in. We took a loan out against the land to get it entitled, and we ended up building 49 homes in there. We did 5 homes at a time. So we got into that deal with no money. The seller made out, brought the builder in, no money down. We used the land as leverage because it was all free and clear. And we did a joint venture partnership with the seller on that one.
wow. What I was going to say is I mean, it seems like the name implies, I mean, you can be so creative with what you do, obviously. Um, how do you know which tool to reach for? How much time does it take to understand your tool belt well enough to be able to, listen to a client's story, listen to their motivations, what they're looking to do, and say, I need the hammer for this, or, we need this drill bit with this impact drill. Like, how do you, how long do you think that takes, or do you need somebody to show you?
Yeah, so it goes back to what I was saying before. The art of doing all these deals is building that relationship with the seller, getting to know them, and the reason why they're going to do that is because they know you and trust you. That's the art of it. Once you understand that and you pull out why they're selling and they're open to telling you why they're selling, and then you can figure out how to be creative enough to solve the problem and knowing what strategy to use. Once you've done a couple of each deals, it's pretty easy. I would say probably about 6 to 8 months because you once you understand the seller, you'll know where they're at, and then at that point you'll know what strategy to use. Like for example, subject to I usually only use when the seller's in a stressful financial or the house some type of distress situation.
Hmm.
Okay. If they're not distressed, then that's when you do one of the other ones, a lease option or the agreement for deed. I like the agreement for deed and land contract because you get the depreciation as the investor, the owner. But if you do a lease option, the seller gets the depreciation on the taxes.
Mm.
But then you also, what I really like about this is when I sell the property to a family that can't buy a home traditionally because they can't qualify and they end up becoming homeowners. That's the part I really enjoy where they actually
Yeah,
like it because you set them up in a strategy, and then over time they build whatever it is a good payment history. They get their credit cleaned up, and they pay you off, and you buy and you cash out in the back end, and they become homeowners and they take care of the property. That is the best feeling, is really helping people out, that type of thing. And then the other thing is, a lot of times people don't realize this when they buy a home, that they can use their IRA and 401k for down payments. A lot of people don't realize that. So that's one of the things that we
for
ask. Do
sure.
you have an IRA or 401k? What's that, Nick?
I was gonna say definitely, and that's really what we're looking to do, and obviously where a natural partnership I think formed between us is just adding to that creative tool belt. There's already so much you can do, but you can also be creative with where that capital comes from. And like you said, a lot of people don't realize that they have 20 to 100K sitting around in an old employer 401k account that can easily be plugged into one of these strategies we've talked about.
Well, what I'm doing right now is because of the affordability factor. I'm going out there buying land, like in the Carolinas, a little northern Florida, just different parts where I'm buying land, subdividing it anywhere between 4 to 8 lots, and I'm putting manufactured homes on because of affordability. Because where else can you
Hmm.
find a home under 300,000? New
Many
home. These
places.
things are very nice, modern, and I will a lot of times I will sell those on seller financing, then create that seller financing note and sell it off into the secondary market. So I'm working with a lot of people that have 401ks and IRAs where they partner up because we're in and out of these things in about 5 to 6 months. So that's one of the main strategies I'm doing right now. So it's just simple, easy. And even myself, every deal that I'm doing right now on these things, I'm doing it inside the solo 401k. When you sell those, the capital gains, you're not getting hit with them and staying inside the retirement.
Absolutely. Yeah, the tax benefits alone are enough to attract lots of people, but there's when you pair it with the seller financing strategies, when you pair it with, the fact that it's not just real estate and it's all these other assets open up to your retirement funds, it's super intriguing, I think, for a lot of people. And I could honestly talk to you about this all day long. I really want to make sure that listeners who are, as fired up about this conversation as I am, and if they're interested in your book, Creative Real Estate Investing, your free course, your mentorship, how can they figure out what the next step is? How can they get in touch with you? Where do they go?
Sure. Where they can Google my name, Mark Monroe Real Estate. That's one of the easiest ways. It's my MARK Monroe. Or my website is mark-monroe.com. And if you're wanting to learn and you don't have a lot of capital and you want to learn how to do real estate, I have a free course. I give that out, kind of go a little bit deeper on these different strategies. I also work with people that want to deploy their capital and put them into some of these assets. I've done some mobile home parks, but right now what we're focusing on is affordability of housing. And we want to help that out because there's still such a huge. I was actually just in Nashville this weekend, and we had the Mortgage Bankers Association. There's still a shortage, he said, of 4.2 million homes in our country of the affordability.
Wow.
And that's kind of the one of the things that we're focusing on. And then part of that new bill that the current administration's trying to get through is they're trying to stop the big corporations buying a lot, like Wall Street buying up a lot of residential homes. But also inside of that, they're also making it easier so the manufacturing homes can be put into communities without jumping through, because those are one of the biggest things right now. I don't know if you've seen what those things look like right now, but they're modern. Clayton Homes is one of them, and Warren Buffett, Berkshire, is one of the biggest owners of that. They do own it. But
Mm.
anyways, that's the direction we're really what we're focusing on right now. So again, if you want, it's Mark Monroe. Just Google me, or and you can get all my social. You can get the free course. If you want to know a little bit more about passing and investing, if you have an IRA or whatever, just reach out and kind of talk and go from there.
Yeah, Mark, this has been a masterclass. Thank you for being so generous with your time and your knowledge. For everybody listening, if you want to go deeper, like Mark said, he has a free seller financing course at sellerfinancingstrategies.com. Is that right?
Yes. Yeah.
Yeah, for the course,
Sellerfinancingstrategies.com is one of the websites. Yeah.
for the
But
course. Yeah, go
yep.
ahead.
No, that won't take you if you want to know about passive income, that won't take you there. That's for the education on the seller financing. But yeah, Mark, if you just Google Mark Monroe, my main website, Mark-Monroe comes up, but in there has links to all these other websites. But yes, sellerfinancingstrategies.com is another one as well.
Perfect. And your book, Creative Real Estate Investing, I believe is on Amazon. Your mentorship program is open. Like he said, just Google him. You'll be able to find him. And if you've been listening today, thinking, I've got retirement money or I've got extra capital, I'd love to put it to work in real estate. In any of these strategies that Mark has described, that's exactly what we can help you do at Safeguard, what Mark can help you do with his courses. Until next time, keep building, keep learning. Super grateful again for you, Mark. Thanks for coming on the show.
Nick,
And we'll see you all
thank
next
you.
time.